What does it really mean to be, truly well-informed about a company like Microsoft, a complex, massive, trillion-dollar entity? Is it just knowing the ticker symbol? Or is there a deeper understanding that can give you a real edge? Today, we're doing a deep dive into Microsoft Corporation. We're pulling directly from a comprehensive equity analysis report, our mission, to unpack its key findings, really scrutinize the investment thinking behind it, and weigh those compelling growth arguments against the very significant risks it faces. We want to give you a shortcut, maybe even an aha moment, to grasp this tech giant's future beyond just the headlines.
Yeah, and what's so fascinating here is that exact tension. You've got this single in-depth analysis making a strong buy case,
Mhm.
but at the same time, it's laying out these really formidable challenges. It's all about understanding the full picture, isn't it? The nuances, not just the good or the bad.
Okay, let's dive in. The report starts by highlighting Microsoft's profound strategic transformation. It sounds like more than just a minor shift. How did they manage that? Shifting their whole center of gravity, especially given their history. What does that mean for them now?
It really has been remarkable. A truly audacious pivot, you could say. They successfully moved their core focus away from that dependence on the, let's face it, mature PC market, and moved decisively into high-growth areas. Cloud computing with Azure, and now, very aggressively, artificial intelligence. Azure isn't just a growth engine anymore. It's now their largest and fastest-growing division. It's driving revenue, it's driving margin expansion. This strategic shift has fundamentally positioned Microsoft as, well, perhaps the primary beneficiary of this whole global enterprise digital transformation wave.
The report also uses that term, a formidable and widening economic moat. We hear moat a lot in investing, but what does that actually mean for Microsoft in practical terms? How does it impact their customers or competitors?
Right. A moat is basically that sustainable competitive edge, something that protects long-term profits from rivals. For Microsoft, it's not just one thing. It's built on several interlocking pillars. First, you've got really high customer switching costs. Think about their ecosystem: Windows Server, Office 365, Dynamics 365. Azure, it's so deeply woven into how businesses operate globally that moving away isn't just complicated, it's often prohibitively expensive and disruptive. That stickiness translates directly into better, more reliable profitability. Second, there are powerful network effects. The value of their platforms actually grows as more people use them, like the universal use of Office file formats, or the huge developer community building on Windows and Azure, or even just collaborating on Teams. More users make it more valuable, which attracts more users. It's a virtuous cycle, makes the products indispensable. And finally, significant intangible assets. A globally recognized brand, over 35,000 patents protecting their innovations, vast amounts of proprietary software. These aren't just abstract ideas, they're real barriers keeping competitors at bay.
Okay, so with that kind of deep entrenchment, I can see why they might command a premium price. But the report says premium valuation justified by superior growth. How do they justify that premium when the company's already enormous? Isn't growth harder at scale?
Essentially, the argument is that the market is willing to pay more because it anticipates truly superior growth ahead, especially from monetizing generative AI, the integration of Copilot, their AI assistant, across the whole software portfolio. That's poised to drive really significant increases in average revenue per user ARPU. This creates a whole new growth vector, likely high margin too, that analysts believe isn't fully baked into current earnings forecasts yet. That potential upside is what justifies paying a premium compared to peers who might not have such a clear path to AI monetization right now.
That makes sense. Could you walk us through the main business segments driving this and how they connect to this AI vision?
Absolutely. Microsoft basically operates in three core segments. First is productivity and business processes. That's forecast to bring in around $86 billion in fiscal 2025. Think Microsoft 365 Office, Teams plus LinkedIn, Dynamics 365. It's a huge engine built on recurring subscription fees. Then you have the intelligent cloud segment. This is the big one, the core growth engine. Forecasted revenue, around $126 billion. The heart of this is Microsoft Azure, their global cloud platform offering infrastructure as a service, platform as a service, key AI and machine learning capabilities. Revenue here is largely consumption-based. Now, what was really strategic is that the segment also includes their traditional on-premise server products. They had the foresight, the guts really, to cannibalize their own profitable on-prem business to push customers towards more stable, recurring cloud revenue. Brilliant move, looking back, secured their future. And finally, there's more personal computing, About $67 billion in forecasted revenue. This includes Windows licensing service devices, gaming Xbox Game Pass, now boosted by Activision Blizzard and Bing Search. But the really interesting thread connecting all of these now is what the report calls the AI flywheel effect. Copilot gets integrated, it drives people to higher tier plans, right? But then the usage data from Copilot feeds back and improves the AI models, which makes the whole ecosystem stickier, more valuable, and that accelerates future growth. It's a self-reinforcing loop.
All right, so the strategy and the vision seem clear. But how does this actually show up on the books, on the balance sheet? The report talks about exceptional financial strength. What are the key trends listeners should focus on there?
The financial health is, well, it's genuinely formidable. If you look over the past 5 years, say FY 2021 to the FY 2025 forecast, total revenue shows impressive, accelerating growth, over 13.5% compound annual growth rate, mostly from intelligent cloud. And importantly, operating income has grown even faster than revenue. That signals significant operating leverage. Profits are scaling faster than sales. Net income more than doubled, projected over $101 billion for FY 2025 TTM. Just exceptional profitability and earnings per share growth. Then look at the balance sheet. Total assets nearly doubled to $619 billion. Total stockholders' equity almost tripled to $343 billion. That shows incredible value creation. But maybe the most impressive part is the cash flow. Net cash from operating activities hit over $136 billion in FY 2025 TTM. This massive cash generation engine lets them self-fund everything. Huge capex for AI and cloud, strategic acquisitions, shareholder returns without straining themselves. It's built for growth.
The report also compares Microsoft to its peers using financial ratios. What does that comparison tell us? What story do those ratios reveal about their business model?
Yeah, looking at the trailing 12 months TTM ratios, Microsoft really stands out. Their gross margin is exceptional at 68.8%, and the net profit margin, a stunning 36.1%. Just for context, Apple's net margin is around 24.3%, Alphabet's about 28.6%, the tech industry average might be closer to 20-25%. This really highlights the high margin nature of their software and cloud businesses and their pricing power due to how embedded they are. Their return on equity, 32.4%, and return on assets, 18.2%, are also elite. Very efficient use of capital. What's interesting is that while we group them with other tech giants, Microsoft's model is arguably the most balanced. They have these two massive, high-growth, high-margin engines in productivity and cloud. That's different from competitors who might be more reliant on, say, cyclical consumer hardware or volatile ad revenues. It gives Microsoft a more resilient foundation.
Okay, so strong numbers.
Yeah.
But beyond the financials, how does this translate into that unique competitive advantage the report mentions? What are the intangible strengths?
Exactly. It's not just the numbers, it's those qualitative factors too. We talked about the wide economic moat, those high switching costs, network effects, intangible assets like the brand, the 35,000 plus patents. If you look through the lens of Porter's 5 forces, yes, there's high competitive rivalry. They fight hard with other giants. But crucially, the barriers to entry are exceptionally high. The threat of new entrants is very low. You need immense capital and an established ecosystem. Even the threat of substitute products is relatively low, especially for their core enterprise customers.
And the report gives a lot of credit to the leadership for this recent success.
Yeah.
How significant has their impact been? People like Satya Nadella, Amy Hood.
Oh, massively significant. The impact of Satya Nadella since taking over as CEO in 2014 really can't be overstated. He orchestrated one of the most impressive corporate turnarounds ever, shifting focus from defending Windows to embracing cloud-first, AI-powered. And crucially, he changed the culture, fostered this growth mindset, encouraging collaboration, innovation, even working with former rivals. And alongside him, Amy Hood, as CFO since 2013, has been absolutely pivotal. She's brought rigorous financial discipline, incredibly smart capital allocation, overseeing dozens of acquisitions, managing tens of billions in annual capex, all while consistently expanding margins. A very effective partnership.
Are there other, maybe less obvious, unique characteristics or secret weapons that strengthen Microsoft's position right now?
I'd highlight two that are particularly significant, maybe sometimes underestimated. First, that OpenAI partnership. Microsoft's multi-billion-dollar investment isn't just money. It gives them preferential early access to cutting-edge AI models. This lets them weave generative AI like Copilot into their existing massive enterprise software base faster than almost anyone else. That's a huge first-mover advantage in enterprise AI. Second, the Activision Blizzard acquisition, nearly $69 billion, a landmark deal. It massively boosts their gaming division Xbox Game Pass, bringing in huge franchises like Call of Duty, World of Warcraft. But it also gives them a vital foothold in mobile gaming and potential future platforms like the metaverse. It's about future-proofing their entertainment side.
Okay, now we have to look at the other side of the coin. No deep dive is complete without that. The report is clear. The investment thesis is not without risk. So what are the main concerns that you, the listener, need to keep in mind?
Absolutely. The report details several key risks. Operationally, there's a high vulnerability to cybercrime and security flaws. Imagine a major breach in Azure. That could severely damage trust and reputation, especially given how critical cloud services are. And while they've diversified hugely, there's still some exposure to the mature cyclical PC market via Windows licensing that can fluctuate with consumer spending. Then there's the industry itself. Intense and escalating competition. Microsoft is in a constant battle. Amazon, AWS, Google Cloud, Apple, Salesforce, Oracle, across almost every segment. This could lead to price wars, pressure on margins, and forces them into massive ongoing R&D spending just to stay ahead. And this ties into a crucial point. Their biggest strength, that seamless product integration, is also potentially their biggest regulatory headache. We're seeing significant and increasing antitrust and regulatory scrutiny globally, particularly around bundling practices like Teams with Office 365. This could mean big fines, maybe even forced breakups or changes to how they operate, hitting their strategy or profits. On the macro side, an economic recession is always a risk. Businesses might cut IT spending, hitting Azure growth. And that AI infrastructure investment cycle is huge. We're talking about guided capex around $64.5 billion in FY 2025 alone. That's a massive number. It'll definitely be a drag on free cash flow in the near term, even for Microsoft. Finally, there's execution risk on the AI strategy itself. Can they monetize it effectively without annoying customers with high prices or clunky experiences? That's key.
Right. So even with all that strength, there's definitely some tension, some significant challenges. What stands out to you as maybe the biggest hurdle long term?
For me, I think it's that combination of regulatory scrutiny and the intense AI competition. Can they keep leveraging their integrated ecosystem without constantly fighting regulators worldwide? That's a tricky balancing act. And while they have a strong AI lead now, the competition is fierce and getting fiercer. Maintaining that edge and the high margins everyone expects from AI won't be easy.
Okay, let's pivot to the future then. Given all this, what are the key catalysts that could drive Microsoft stock higher in the next year or two? And what headwinds should we watch out for?
The outlook is still very positive, mainly driven by cloud and AI. The biggest potential catalyst is clearly AI monetization at scale. As Copilot gets widely adopted, it should really boost that average revenue per user, creating billions in new high-margin revenue. They're already reporting 100 million monthly active users for their AI assistant, so traction is building. Second, sustained cloud market share gains. Azure holds about 20% share now, versus AWS at 30%, but it's growing fast in a market projected to hit $5 trillion by 2044. Management's expecting strong Azure growth, like 37% next quarter. Third, gaming division growth. Fully integrating Activision Blizzard should drive more high-margin Game Pass subscriptions and really broaden their reach. As for potential headwinds, ongoing macroeconomic uncertainty is the main one could slow down spending. The sheer size of the AI infrastructure investments will continue to weigh on near-term cash flow, though that spending growth should moderate eventually. And of course, intensified AI competition could eventually put pressure on those premium AI margins.
So bringing it all together, strategy, financials, risks, catalysts. What's the final valuation picture the report presents for Microsoft?
The analysis uses a few methods. Their discounted cash flow DCF model points to an intrinsic value around $592 per share. Then, relative valuation, comparing it to peers like Apple and Alphabet, suggests Microsoft justifies a premium due to its better growth outlook and AI leadership. You combine that with the broader analyst consensus price target, which generally falls in the $600 to $620 range, and the report synthesizes a fair value range of about $580 to $620 per share. Now, with the stock trading somewhere around $522 currently, that range suggests a potential upside of, 11% to 19% over the next 12 months. That's pretty compelling for a company of this scale and quality.
So considering the strengths, the growth story, but also acknowledging those very real risks we discussed, what's the final investment recommendation coming out of this deep dive for you, the listener?
The bottom line from this analysis is a clear BUI recommendation. Microsoft has truly transformed itself into a dominant player in cloud and now AI. Its financial performance is genuinely elite, strong growth, great profitability, massive cash flow. And that economic moat. It seems to be getting wider thanks to AI integration. Yes, it faces real risks. Competition is fierce, regulators are watching closely, but its leading position in AI offers a very clear path to continued double-digit growth. The analysis concludes that the current market price probably doesn't fully reflect the transformative potential of that AI monetization strategy yet.
Wow, what a deep dive indeed. Hopefully, you now have a much clearer understanding of why Microsoft is seen as such a premium investment. but also a very clear picture of the significant hurdles it still needs to navigate. It's a fascinating story of innovation, big bets, and ongoing risk.
Exactly. And if you connect this back to the bigger picture, this Microsoft analysis really highlights something important. Even for a company this dominant, this well-run, the future is always this balancing act between huge opportunity and unavoidable challenges. For you, the listener, understanding both sides of that equation is absolutely crucial for making truly informed investment decisions, especially with these tech giants.
We've aimed to give you the tools to understand this complex situation better. So what's one question you have now? What's one area you might want to explore further about Microsoft's future? Maybe think about that constant tension, the incredible promise of AI versus that persistent regulatory spotlight. Where does the balance lie? If you want to keep getting the fastest, most frequent updates on complex topics just like this one, making sure you're always well informed, please do subscribe to The Deep Dive.